Chapter 10, Property Acquisition and Cost Recovery. So when we talk about cost recovery, and specifically with respect to taxation, obviously there's the basic concept of depreciation, and essentially you are required to capitalize the cost of any asset that has a useful life of more than 1 year, so that you cannot immediately expense the item on your balance sheet. And with the taxation perspective on this, the reasoning is that basically the IRS doesn't want you to take advantage today fully of the costs of an item that you will be using the benefits of years into the future. So since that asset will be useful for multiple years, the IRS requires you to capitalize the cost of that to more accurately reflect the year-to-year usage of the asset. So obviously you want to recover that cost so that you can take advantage of that and reduce your taxable income. And the manner that you have to do that, if you capitalize, is either through depreciation, amortization, or depletion, which all three are basically the same thing. They function slightly differently, and they're named differently based on the type of the underlying asset that you are trying to recover the cost of. So here are the three methods: depreciation, amortization, depletion. Use depreciation for the cost of tangible personal and real property that's not land, because you don't depreciate land, over a specific period of time. Amortization, you are deducting the cost of intangible property over a specific period of time. So basically, it functions similarly to depreciation of an intangible asset. And then depletion, again, functions like depreciation, but has to do with natural resources and more accurately reflects the nature of what's happening there, where you are depleting the stores of that particular asset from the ground or wherever you're getting it from. So your basis generally starts when you purchase the asset, and the cost of the asset is your initial basis, similar to financial accounting. And then at that same time, the clock starts rolling for the recovery of the cost of that asset. As you go recovering the cost of that asset, whether it be through depletion, amortization, or depreciation, you are lowering the tax basis of the asset. And as you do that, you are creating an assets adjusted basis, which is also known as the tax basis of that particular asset. And obviously the tax basis is going to be probably different than the financial accounting basis of the asset, because there are specific depreciation or amortization or depletion setups based on whether you're doing, or basically there are specific ways that you're required to recognize or recover, I should say, the cost of these assets through the taxation system that is different from the way you have to do it for financial accounting purposes. So you're going to basically have two separate bases, or bases, I should say. So here's an example for basis. Scrap Happy Inc. Scrapbooking retail chain purchased an old office building for $175,000 for use in expanding its current operations. An additional $15,000 was spent painting and remodeling the building in preparation for its opening. 2 years later, a Scrap Happy employee discovered that several leaks in the roof were causing serious water damage to the store's inventory. The company spent $50,000 to re-roof the building. In addition to that, we have this information that every 6 months, Scrap Happy pays $500 to have the carpet professionally cleaned. Isn't that nice? What is the original basis of the building? Well, that would be the initial cost plus the painting and remodeling necessary to get it up to snuff. Based on the other two transactions, what changed to the basis? Well, the re-roofing expense results in a restoration of a major component of the building. So this is essentially a capital improvement and not just routine maintenance, in which case we can add the cost of that $50,000 to the basis. Now the $500 biannual carpet cleaning is routine maintenance, therefore it will be expensed immediately and no effect on the basis. This is just a chart that shows what we already talked about, which types of property require which types of cost recovery method. Just a little bit of history with depreciation, at least with respect to taxation. We don't really care much about the history. We can just look at that last bullet point and see that currently businesses calculate their tax depreciation using the MAKERS system, which stands for Modified Accelerated Cost Recovery System, again pronounced MAKERS by tax accountants. To be able to calculate MAKERS, you need to know this information outlined in these bullet points. Original cost, applicable depreciation method, recovery period, aka depreciable life, applicable depreciation convention, depreciation deductible in the year of acquisition and the year of disposition. We'll take a look at those in a minute here. So what is personal property? This includes all tangible property, as you can see here, such as computers, automobiles, furniture, machinery, and equipment other than real property. Personal use property and personal property, often people confuse the two of those. Personal property just means, as you see in parentheses, that it's not real property, whereas personal use property could be either personal property or real property, but all that means is that it's used for personal purposes. So try not to confuse those, either how you see them or how you say them. Continuing on with personal property, there's three different methods that are acceptable for depreciating personal property. Double declining balance, which hopefully you can remember what that, how that works from your financial accounting classes. 150% declining balance, which I'm not sure I've ever talked about in any class that I've ever taught. So that functions just like double declining balance, but instead of 200%, you're using 150%. And then straight line obviously functions where you're basically amortizing the depreciation amount equally over whatever time period you're looking at. Now, when we're trying to figure out what the recovery period is for tax purposes, all we got to do is basically look at the revenue procedure 8756, which helps you to classify various types of assets into categories, and then gives you what the essentially the life of that asset should be for tax purposes. Again, like I said, once you figure out which category all the assets that you're concerned with go in, then you just look at the revenue procedure and can see what the recovery period is for each of them. Obviously, this isn't the whole thing, but this gives you a look at what a portion of this revenue procedure looks like. It's basically in chart form, and pretty easily able to classify most assets into one of the categories that's listed on 8756. And you see there, these are the most common business assets that most people deal with. And from 8756, we can see that recovery period on a lot of these normal capital assets for a business are 5 and 7 years respectively. The next thing we want to take a look at are these depreciation conventions. So for the IRS under makers, most of the time you fall under this half-year convention. And what that basically does is it tells you how to handle depreciation for the year an asset was placed in service and for the year the asset is eventually taken out of service. So if you're under the half-year convention, then you are able to take half of 1 year's worth of depreciation in the year that the asset was put into service, regardless of what point in that year it was put into service. And then the year that it comes out of service, you're only allowed to take a half year's worth of depreciation in that year as well. So again, that happens most of the time. But depending on how you answer these three questions here, you may have to use the mid-quarter convention. And under the mid-quarter convention, you look at whatever point in time the asset was placed in service, which quarter was that in, and regardless of what point within that quarter it was in, we will assume the asset was placed into service at the midway point through the quarter. So you have to use, you don't get to choose between these two methods. You have to use the mid-quarter method if after following these steps you determine that it has to be used. Otherwise, you have to use the half-year convention. So first, sum up the total basis of tangible personal property that was placed in service during the current year. Then you're going to sum the total basis of tangible personal property that was placed in service during the fourth quarter, and you will divide step 2 by step 1. If the quotient is more than 40%, then the business must use the mid-quarter convention. Otherwise, the half-year convention is used. So basically what you're looking at is, did you place 40% or more dollars worth, I should say, of tangible personal property into service during the fourth quarter of the year? If more than, I said that wrong. If more than 40% of the tangible personal property that you place into service during the year occurs during the fourth quarter of the year, then you have to use the mid-quarter convention. Otherwise, you have to use the half-year convention. So you basically just follow these steps anytime you're trying for tax purposes to depreciate personal property. Again, this is not personal use property. This is actual personal property, meaning not real property. So you locate the applicable table in 8757, select the column that corresponds with the asset's recovery period, find the row identifying the year of the asset's recovery period, and either apply half-year or mid-quarter convention, and basically that's what you do. Here's a look at the table. Look at the mid-quarter depreciation table for personal property by quarter placed in service and recovery period. So basically we're just plugging in, once we figure out the characteristics of the assets we're talking about, what group they go in, how many years we're talking about, whether they're under mid-quarter or mid-year, then we're basically just finding that amount on the chart and going from there. This is just a chart that shows if you're under the mid-quarter convention, how do you deal with depreciation and what percentage of a full year's worth of depreciation are you allowed to claim in the year that you dispose of the asset. So here's an example. In 2016, Scrap Happy purchased and placed in service the following assets. Got a die cut machine for $3,500, February 2nd, which is during the first quarter. We got a computer for $1,200, October 25th, during the fourth quarter. What is the recovery period for each of these assets? Well, we just look at the type of asset that they are. We look at the chart, and we find out that a computer's 5-year recovery period and a die cut machine would be 7 years. In this case, which convention should Scrap Happy use to determine depreciation for 2016? Well, we can easily look at this without even trying to calculate anything and say, well, given we only had these two assets that were placed in service during the year, and the more costly asset was placed in service during the first part of the year and not the end, we know that this is not going to be over 40%. If these were flip-flopped, then we would have a different story. Then we would have to use the mid-quarter convention. But since less than 40% of the assets placed in service this year were during the fourth quarter, we can use, and have to use, in fact, the mid-year convention. So this is just what I was saying, the opposite of that, where we flip-flopped the assets to the first quarter and fourth quarter. And so now, greater than 40% of the assets that we placed in service during this year were placed in service during the fourth quarter. So what does that mean? That means we have to use the mid-quarter calculation. Based on that, we would look at the makers tables under mid-quarter and find the rates and multiply those rates times the value of the asset. And there you have it. Now that we were just talking about personal property, what about real property? It uses mid-month convention and it uses straight line method. These are the recovery periods based on the type of real estate that it is, real property, and there you have it. So based on this example, we got July 12th, Scrap Happy purchases and places in service a warehouse and the land it resides on for $170,000. $120,000 is allocated to the building and $50,000 to the land. Obviously that's important because land is not depreciable. What is the amount of depreciation on the property for the first year? Answer, 120,000 times 1.177%, or $1,412. Again, to find that percentage rate, all we have to do is look at the makers table under the column for the 7th month, and we would get that rate. I'm not going to talk too much about these, but just be aware, and if you want to look more at this, you can under Section 179. There are some times when you're allowed to immediately expense some things. Obviously, that's limited, and based on 179, you can choose which assets to immediately expense. Typically, when Congress or the IRS has included some type of bonus depreciation, as I've talked about before, there's policy implications, policy reasons that those are included, and generally it's some economic stimulus that is the end goal for allowing bonus depreciation. Actually, this is just kind of a confusing slide, so I'm not even going to talk about this one. And in fact, I am going to delete it. Okay, so we do have some specific limits for luxury automobiles. You can see that in a chart here. Tax is full of little specific details like this, but just knowing that luxury automobiles are a separate category. Can help you here. All right, we're going to move on to amortization now. And typically, amortization functions very similarly to depreciation, except, of course, now we're dealing with these various types of intangibles, which you can see some of the asset characteristics there for Section 197 intangibles. We've got some startup and organizational costs, research and development costs, and more commonly, patents and copyrights. So for 197 intangibles, you've got a 180-month or 15-year recovery period, regardless of what the actual life of that intangible asset is. For these types of assets, we use the full month convention, where you basically, regardless of what time or what day of the month this amortization begins, you are allowed a full month's worth of amortization for that and all subsequent months leading up to that 180-month time period. This is just explaining what startup costs are. I won't get into that too much. Research and experimentation, also known as research and development. Typically, you're able to either immediately expense, as you can see in the second bullet point, or capitalize and amortize these costs over at least a 60-month, 5-year period, beginning the month benefits are first derived from the research. So basically, typically that means when this research is monetized. So for patents and copyrights, it depends on how you acquire the patent or copyright. If you purchase it from someone else, some other entity, you amortize the full cost over the remaining life of the patent or copyright. If you basically are getting a patent or copyright on something that your business created itself, then you have the choice, well, not really the choice, but you have the shorter of either the legal life or the remaining useful life of the asset is the time period that you would use to amortize that cost. Here's just a little explanation of the various types of amortization, or I should say the various categories of amortization and recovery period. All of these are straight line. That's basically what amortization means. And then I think that last column there is not necessarily terribly important to look at, but does outline some of the differences between tax and financial accounting, especially with respect to these intangible assets. That's pretty substantial. Depletion is the method that you use to deal with assets that typically are natural resources of some type. So for depletion, we're basically trying to estimate however much of whatever of these natural resource assets there is left, and essentially dividing that into units and then allocating a pro rata share of that basis to each unit that's extracted during the year. So you're basically finding, okay, what's the total barrels of oil that I have left in this property at the beginning of the year? And then allocating essentially a cost per barrel, and then based on how much you extract from that property during the year, that's how much cost recovery through depletion you're able to take. So here's an example of cost depletion. Scrap Happy purchases a tract of forest land, which they plan to use to harvest trees for the production of scrapbook paper. It is estimated that the tract contains 30,000 board feet of timber. The original cost of the property is $75,000, of which $60,000 is allocated to the timber and $15,000 to the land. What is the cost depletion per board foot? Well, again, $60,000 basis divided by number of board feet of timber in the land and that gives you a cost per foot. And then you look at how much was extracted during the year and multiply that times the amount per foot, and you get $20,000 in this case. Once the entire cost is recovered through depletion, that's the end of using cost depletion for depletion expense for that, at least for that particular asset. I'm not going to get into these depletion rates all that much. This is the last slide on here. This just shows that there are different depletion rates that are statutorily prescribed based on what type of asset we're looking at. And that's referring back to this second bullet point here.